Mortgage insurance. What is it? Why do I have it? And how can I remove it? What is it? Simply put, mortgage insurance is an insurance that's in place to protect the lender in the event that the buyer does not pay their mortgage. It's very similar to car insurance. You have car insurance right now in the unlikely event you have an accident that you can recover your loss. Same thing for lenders. They want to make sure that, hey, if I loan this borrower this money, if they don't pay, I can recover my loss. Same thing. Now, why do you have it? There could be a couple of reasons. One being you borrow with the FHA loan product. FHA requires mortgage insurance on their loans 100% of the time. But there's a way to get it off. Stay tuned. I'll talk about that in a second. On the contrary, VA, if you're a veteran, you are not going to have mortgage insurance. I'll talk about how much you can save with that shortly as well. But first, the other reason you will have mortgage insurance is because you borrow more than 80% of the value of the home. Let's talk numbers. Let's say a consumer got a conventional loan product and they only wanted to put 5% down. If you put 5% down of a $500,000 home, that's going to be $25,000. So at the end of the day, you're going to borrow $475,000. That's your $500,000 less the $25,000 down payment leaves you with a balance that you'll need to borrow from the lender of $475,000. On that amount, let's say your mortgage insurance payments would probably be roughly about $200, maybe somewhere between $220, $240. Okay. So now that we know when mortgage insurance is required, let's talk about how we can get it removed. One way is never to have it. If you borrow money with any product outside of FHA and you put more than 20% down, you won't have mortgage insurance. But let's say you don't have that amount for a down payment. I get it. A lot of people do not. I didn't when I got my first home. How do I get this extra $200 and something off my mortgage payment without putting 20% down? Now, it's not going to happen overnight because at the end of the day, the lenders want to protect themselves. But what you have to pay particular attention to is when the value on your loan is less than 80% of the value of your home. So in the same scenario that I discussed earlier, a $500,000 home that you put $25,000 down and you now have a loan balance of $475,000, homes are going to appreciate. That's what history tells us. It's not very often that you're going to see a dip in your home value, okay? So you'll watch that home knowing that your home appraised at $500,000 or more. But when your loan balance becomes $400,000 or less, you make sure your value on your home is still the same, and you're going to call your lender and say, hey, I want to refinance. Now, this method applies for FHA too. So even though FHA requires mortgage insurance on 100% of their loans, you don't have to remain in the FHA loan for the life of the loan. You can refinance to a conventional loan product and get that mortgage insurance removed. But before you do that, especially for people that bought a home recently when the rates were historically low, if you got a 2 or 3% interest rate, it may not benefit you to go refinance and get your mortgage insurance off because your mortgage payment may be less even with the mortgage insurance. I hope this helps. If you have any questions or comments, just go ahead and drop them in there. I'll be sure to respond. If you don't know who I am, I'm Keisha, the key to your keys. Thanks for tuning in. Don't forget to hit that like and subscribe button. There's more to come.